What's up, y'all? It's Bobby here again, and today we got the three men of the group. We got Jeremy, Samson, Brad. We're calling this Around the Horn. We're going to talk about a lot of different stuff, but what's up, gentlemen? Late evening across the globe here. How are we feeling? What's going on?
I'm actually really intrigued on what's sitting on your piano in the background over there. What are those?
Oh, yeah. I got some custom-made pillows. You can basically upload anything you want and get it put on a pillow, and I got a bunch of designs.
What? Why don't we have Growth Vue pillows?
I want all of your faces on pillows.
Yeah, get your first LP check on a pillow. Just hit me up, y'all.
That's right.
That's what's up. Yeah, let's do that. Those would be great investor gifts.
Heck yeah.
Just Brad's face on a pillow. I know a few ladies that would really love to have that pillow. His mom, his aunt.
My grandma.
Grandma.
All right, fellas. What's up, Jeremy? How you feeling, man?
Feeling good, man. It's been a long week. We're heading into Friday tomorrow.
It's Friday then. It's Saturday,
right.
Sunday. What?
San Diego on a Friday. I'm trying to actually hang out in San Diego this weekend. So, Brad, if you're around, let me know.
Oh man, I'm flying out to Denver, helping a friend move, see my brother, and then flying back to Santa Barbara, hopping on a sailboat and taking a sailboat down Santa Cruz Island and Catalina Island with a buddy through Memorial Day weekend. So that's why I wasn't going to make our regular Monday meeting, and hope to make the one Memorial Day unless we don't have it. But yeah, I'm trying to live out that passive investor lifestyle as much as possible.
Man, raising capital is hard.
It is hard. I think I had like 2 or 3 days of some stress. Once we pulled in all those checks, I was kind of able to float it. But yeah, we kind of bebop down the coast. We got some people that we're going to meet up with, and kind of not a better way to meet up with other interested accredited investors who want passive lifestyles than meet them on boats. So it's been kind of my lifestyle to do that, get some time freedom, get some financial freedom, and meet other people that have those same priorities, and just roll with it and meet them organically and then pull them into our network.
You know what I think makes you a good capital raiser? Because you've been around the world. You're probably one of the most interesting men in the world. Dude, last time we talked, you told me you were like in musical and like choir and all this other stuff that I didn't know about you. You freaking swim, you dive, you sail, you undo bombs, you protect
I was gonna be like, you
borders.
defuse bombs. Like, that's dope.
You sail. You're incredibly good looking. What don't you do?
You left out speak French, play banjo, guitar, mandolin, a little bit of harmonica around at the campfire.
Yeah.
Occasionally, I like to take long walks on the beach.
Yeah, you do that quite frequently, actually. Not occasionally, but that makes you able to just connect to anybody with like a story about something.
Yeah, that's why I enjoy this. I was on a podcast today called the Investing by the Slice, and it's just great to tell that story of why we're together as a team, why I get excited about this every day that I wake up, why we do what we do. And real estate is just the means to an ends, which fulfills our purpose and lifestyle. And so it's fun to hop on and do that on these podcasts and do it with investors and tell them about your guys' brains and your hearts and where you're going and what you want to do. The vision that you have, Samson, is just incredible. So, and then Jeremy's capability is next level. So, they asked me, 3 terms that I could give out to like new investors that would help them on their journey. And I said, teamwork, teamwork, teamwork. So the teamwork aspect of it has just been able to propel us in crazy different places. It gives me confidence to go out and capital raise and tell our story and talk to people that are interested, find some connective tissue, find out how we can help them with a problem they have, and then just take off from there. Then once it gets into the deep analytics, I got to call in from backup for my boy Jeremy, because I'm like, yo, bro, I need some wave tops. Hit me with what's good.
Yeah. Well, let's hit some wave tops tonight. I think we're awesome. Around the horn.
Yeah,
the horns about
on the start of it, Bitcoin's down. The stock market's definitely down right now. So I've been getting a lot of calls of people that are interested in evergreen products, which is, multifamily investing. And I kind of think that's the start of the conversation to say, like, there's a lot of capital out there. There's a lot of people that want to protect their capital that's out there. But a lot of people are scared to put their money in the stock market right now. They don't know where it's going to go, what it's going to do. So kind of going around the horn, Jeremy knows way more about those fundamentals, and Samson knows way more about those fundamentals than I do. But just seeing the impact of the emotion that's coming from the investor, and getting multiple calls all the time. People are like, hey, we want a place, we want to put it somewhere. We've heard of what you guys are doing. We know why it's safe. So that's kind of the impetus and what I'm hearing a lot on each one of these investor calls, and kind of across the market and things I'm reading. How about you guys?
It's just capitulation, like pure fear. One of the pros to like stock market or crypto or Bitcoin or whatever is easy. Anybody can do it. It's a totally different skill set to go and buy an apartment complex, right? And so I think that's why we do it. It's harder, right? The con to that is liquidity cuts both ways. And so, real estate may not be as liquid, but that also allows you to kind of ride out some of the chaos and remove some of the emotion. And a lot of those emotional decisions are being made at the beginning when you're getting into the deal. And so, yeah, I think, it's been pretty good for the last 2 years. We didn't have a correction like we should have. So we also might be experiencing some delayed response from all the government intervention. We just threw a Band-Aid on a gaping wound and we kicked the can down the road. So that's what I'm saying.
Yeah. I'm the one who's always like talking to these guests and like getting their perspective. And like the one thing I got to keep thinking about is shortage of homes. We've discussed too, Samson, how there's a lack of care, and just while everyone is getting into like apartment investing and syndications, and it seems to be getting more popular as the years go on, there's still a shortage of enough people repairing and want to add value to these like older apartment complexes. So there's just this force upward where we need more supply. I was reading articles how Amazon is taking away so much like whatever is needed to build, the contractors need. Like that's a hot topic. That's super interesting that they are just getting all of these resources. And the most fascinating thing today is our realtor in South Carolina, because we're moving there. Samson's wife's helping us sell this home. Someone wants to buy it off market at a great price. And we're moving to Charleston, and we bought it for $478 or whatever. And the one next door to us that's actually finished being built, ours is going to be built in 3 months. It's listed for $641, and it just doesn't make sense with rates going up and everyone's saying, oh, there's going to be a correction, this, that. Not really seeing anything slow down, and it's almost super awkward. The average American would be like, oh, my home value is going up, great, but it's actually majorly concerning, because you said liquidity cuts both ways. The thing I think about is, if a illiquid good can go up in price that much due to bad monetary decision making and all of this, what could happen to goods people actually do need, where there's like a shortage of them with food, whatever it may be, and like those prices can go up just as much percentage wise, if not more, because they're actually very much needed. So it's just kind of weird to like see it happen. But
Yeah, I mean historically rates have gone up, so housing prices. It's interesting that Costco and Walmart came out with down earnings for the last quarter, but the truth behind that story was they haven't been raising their prices to keep up with their buying needs. And so we haven't even seen the repercussion of them raising prices, right? And that has a ripple effect on people who shop at those places as well as their employees. And so, I still think that the thesis in around affordable, attainable apartments still makes a lot of sense. I mean, at a certain point when rent starts to surpass like the average mortgage, not too many people can afford that. So I don't know. What do you?
That's a good point. Just with your scenario, Bobby, is people are priced out of houses right now. So it's the mechanism, and we talk about it a lot between Samson and I and Jeremy, is the macroeconomics of what's pushing this. Even with interest rates going up, that doesn't mean there's any new supply coming on board. So the population is continuing to expand. The supply of homes is not. In fact, it's dwindling. So that those major drivers for macroeconomics is still causing home prices to be very expensive. At the same time, these large generations with the baby boomers moving out of their houses and going into apartment living, millennials, which are significantly larger than the boomers, have been in apartments for the longest out of any generation in history, and they can't afford to buy their first single family home. Well, now they're getting into their late 30s, early 40s on the millennial side. They're still in apartments. That's a huge population. And they're looking to buy something, and they may even have money to buy something, but there's just not enough on the market. And every time they go to look for a home, there's 20, 30, 40 buyers in the stack. Some of them are all cash buyers, so they can't even get in. And then we kind of see the next generations coming up behind that. The Gen Zs, they saw their parents get burned in the 07 to 12 single family home crisis. And here they are kind of in their early 20s, mid 20s. Maybe they might be, the early ones are thinking about getting homes, maybe, but now they're looking at this, and it's going to push them further away from home buying and keep them in apartment living where they've been comfortable. So I think those major macroeconomics are really going to continue to drive up commercial multifamily apartment investing, commercial multifamily apartment living, and being in that sweet spot right now where we're in the B grade light value add is going to be the place to be for the next 10 years, because supply and materials, construction cost, insurance costs, all that's going to keep going up for all these new builds, on top of more difficult government assessments, engineering, environmental, that just makes it tougher and tougher for developers to put new A-grade product on the market. So I think we're not going to see a real tumble in commercial multifamily for the next 10 years minimum.
Yeah, I mean, that still sets up our thesis too about affordability. So Midwest, Southeast, and then you throw in the fact that, you know, we're in probably deglobalization, and we see a lot of manufacturing and production come back to the United States, just given everything that's going on at the macro level. So, you know, people will be moving for affordability, jobs will end up there, more people will move there, and the history repeats itself. I mean, we saw Texas, Denver, you know, all these major metros grow over the last 10 years. For the first time ever, you're hearing people say, it's getting crowded in Colorado, it's getting crowded in Dallas. So where are they going? They're going up to Arkansas, they're going up to Oklahoma. People from Colorado are going to Kansas, going to Missouri. So it's interesting dynamic.
Yeah, with that deglobalization as well, we're looking at just a lot more uncertainty in the foreign markets, especially the European markets right now. So a lot of that money that was maybe in a standard like German, manufacturing or investments there, Polish, and especially the Far East Europe, they're starting to move money into the United States for just more security. Same thing as tensions are rising with China and the Far East Asia. A lot of that money is moving into the States, as what you see in China right now. They're having a very hard time with production because they keep getting locked down from COVID. So their exports are shot, and they have been, and there's a prediction that they will continue to be that way, which is going to force more of products, manufacturing, farming, oil production back to the United States as we deglobalize. And then those people that have been in those major metropolitan cities, San Francisco, New York, Denver's, Chicago's and stuff like that, those people are going to be moving out as these production jobs come back to the Midwest, and they come back to the South in particular. So that's kind of why we're targeting those markets specifically, is that net migration of people are moving towards these jobs that are coming back to the US, and they're going to come back at higher income levels than when they left in the early 2000s. The production level is going to stay high and rampant for the next 5, 10, 15, 20 years as we move through a pretty unstable time. And that's just coming from my military background and kind of knowing what's going to be going on from now till 2040, which is really where all of our military forces are focusing on that time frame because there's going to be multiple large engagements between now and then. It's kind of going to destabilize the rest of the world, pump a lot of capital into U.S. markets, and U.S. markets are going to be stable.
A lot of what we're hearing too, and I guess what we're trying to get in front of is a lot of these from the multifamily acquisition side of the value add space, a lot of these institutional capital folks that are looking to deploy money into the core markets and have really compressed the caps as we've seen over the past 24 months. It's been, I think, faster than any time previously. Now getting into the markets ahead of these folks in these larger groups to build a portfolio and maybe sell as our exit to these larger institutional folks. So looking at markets like Cincinnati or Louisville, that wasn't hot on the radar, but everything is becoming so much more competitive in a more core market like a Denver or a Dallas, that we can still get some cash flow on a Midwest market and potentially now some upside that's not necessarily baked into the underwrite. So a little bit of both worlds on that scenario. And then going back to I'm looking at residential prices at all times, because I still rent and I'm in San Diego, and the prices here are just crazy appreciating. But I look at my rent renewal when it comes in, and I'm looking around, I'm like, well, there's nothing else out there that's comparable to what I'm in to go and switch to. So although my bill just went up 10% and it's now, actually, no, it's more like 15%. And in San Diego, that's $450, $500. Well, I can go and move somewhere else for cheaper, but the reality is, no, you can't. And unless you had that rate locked in 2 or 3 months ago, as you're sitting here in mid-May, it's more expensive to purchase a house, and now your buying power might not be that. The median price now in San Diego is for a single family home is $1 million, which is crazy. But the average median, including condos and single family, is closer to like 700 or 800. So now you're not even probably able to afford that today if that was your stretch 3 months ago. So just interesting to see all these different things that come into play as we're buying and looking at our tenant base.
Well, do you want to buy what you can get for $1 million in San Diego?
The thing. I have a rooftop pool. I've got barbecue grills. I've got a beautiful place to live, 2-bedroom, and it's not like we're stretched beyond our means. It's just comfortable. That something of this similar quality, if we were to buy, would be probably double on a mortgage, or 1.5 plus X on a mortgage plus a down payment. So,
and throw in the fact that like you and your wife live the laptop lifestyle, as most people are, and so you buy a house and all of a sudden you have to take care of it when you're not there, when you're gone for 2 or 3 weeks.
Yeah, we're not in town a lot. We're actually leaving town again next Friday for a week. So it's just being able to leave it and forget it is nice. And that, again, providing that from the property management company that's here. And I know we don't buy in California per se, but the markets that we do buy in, having that good, strong property management relationship, I'm always talking with those guys upstairs, bugging them in the leasing office.
You're that guy. You're that resident.
Yeah, and I'm touring. I'm touring another property that opened here on Saturday. They're charging $6,500 for a 2-bedroom in San Diego. I mean, anywhere, that's absurd. But I'm just curious to see how they're leasing, because if they opened up 18 months ago, they'd be shit out of luck. Today, they're catching the tops of the waves. So I'm just, trying to figure out. I'm curious to see what their lease up velocity has been in this environment, because they have like 200 units and it's top of the line luxury, but that's also way above any other comps in the market. So just always doing my market research.
Yeah, but that's very indicative of pretty much the normal renter right now. You're in your kind of low 30s there, married, no kids, great incomes, dual incomes, and you want nice amenities and stay in a nice place. And it's tough, and you're an expert in real estate. So imagine the people that aren't experts in real estate. how hard it is for them. So kind of continues to show that, multifamily is going to stay strong, even as interest rates go up, because there's really not a whole lot of choice right now.
I think the home starts is a good leading indicator that's going to forecast. And that, since 2006 at the peak, 2009 when it really hit the trough, we started to say, hey, we got to start building again. It's just been steadily increasing the amount of home starts, and we're kind of hit that perfect storm where everyone's looking to spread out during COVID and lockdowns, and so people were staying put because they didn't know what was going on. But then eventually, like, okay, yeah, we can move around, and we have to move around. But the amount of now inventory that's on the market, not only from new builds but also existing inventory, is at all-time low. I think Bobby shared a chart a couple months ago. Normally it's like 1 million plus, I forget the exact numbers, and as of lately we've been closer to like 250 or 350K. So we're at a quarter or a third of the amount of inventory nationwide that's normally on the market. And so the whole supply demand equilibrium is way out of balance. Obviously the Fed fighting that with the increase in interest rates and trying to taper down inflation from a home perspective, a home valuation perspective. It seemed to do a decent job, but I still think we have a few more hikes to go. We got another one coming up in June, and I think it's going to be the same 50 basis point swing. And from what I've been hearing and listening to, and on the different areas we get our information from.
What do you think that 50 basis points is going to do for being able to lock in financing for future projects?
Yeah, I mean, we were just out to market on a project for us, and getting that, we look at bridge debt for our typical loan. So it's a little bit different because it's not fixed like a residential family home might be for 30 years. It's more the type of loan that we get is a bridge loan. They do have 10-year fixed, but they don't really, the way that they size up their loans just constrains the proceeds. So to do our deals, we look at floating rate, which is scary if you don't understand it, but you can always mitigate a floating rate by buying interest rate caps or hedging it with an interest reserve with your lender. But anyway, I digress. I think that over the next few months, we're going to see lenders starting to increase what they call their spread. That's their coupon that they charge, and that stays fixed throughout the loan period. But SOFR is going to continue to increase. That's the traditional, like 10-year treasury is to Freddie, Fannie. SOFR is to bridge lenders, the secured overnight funding rate. And that's going to continue to increase. So what you could borrow at for the last few months, for the last year plus, has been, call it 4%, because SOFR has been at 0. Today it's at 0.8. And the forward curve that we are looking at, that's forecasted by the Fed, is going to be 2.5% by the end of year 2. So that 2.5 plus the spread, you're going to see interest rates for us in the 6%, 6.5% range pretty quickly here. And now whether the Fed sticks to their guns like they have the last 2 meetings will be determined on, I think, what they're getting and the feedback that they're seeing from the US.
Yeah, they won't come back down until they see the capital markets start to lock up and money not moving.
We've seen the NASDAQ taking a pretty deep dive, I think 30% down on the year so far. S&P and Dow like closer to 15%. But there were some pretty hefty valuations. I think a lot of stimulus money that sloshed around into some of the tech companies, little extreme valuations on the multiples of earnings. So
I definitely think that even in those markets, publicly traded companies not making money and not cash flowing is no longer going to be as sexy. People just got their butts whooped in the market buying companies that don't make any money, and that's been the game for a lot of years, which is raise a bunch of money and spin up the business and go public and sell it, and founders make a ton of money, and the business can still keep going and grossing revenue and increasing revenue, but not really making money. So I think that sentiment will start to change. You're starting to see it in private equity work.
On that note, Samson, I work at a startup right now, and we're hearing from a lot of the VCs, and like Y Combinator made an announcement today. Like you really need to start planning for instead of 18 months runway, 30 plus months. And if you're like a Series A company and you don't have product market fit, you've got even bigger issues because you're at a point where you need to be validating your idea and actually making money. And yeah, there's going to be a lot of slowdown there. And that's where people love to allocate money like into these things that are based on the future. But with the future being uncertain, it's like money's going to pile into a lot less things. And what I think is pretty fascinating, I heard a stat today from the director of global macro at Fidelity. He said all bear markets since 1871, the median bear takes 21 months at a 30% drawdown, and a non-recession tends to be shorter and shallower, declining 22% over 4.2 months. Here's the graphic, but so far we're down 20% in 4.5 months. So these final two lines, like this is pretty insightful as far as like the norm. And I know these numbers are a lot higher now, so the percentages, like smaller percentages, could actually be more.
Can you zoom in on that a little
potentially.
bit? Give it a click. There we go. Yeah, I mean, this whole game of just come up with an idea, don't actually have any real income or money, you know, buy all the cool fancy shit, hire a bunch of employees, go public, is really going to be challenged with who's the real entrepreneur, who can bootstrap something from nothing and actually get to cash flow and get to income producing and grow the business, and then go take it to market and then go raise some money. Prove the concept. People are gonna have to prove it before they can get the cash. No more selling ideas and pipe dreams.
This is why I've
We're
been
going to see kind of a move away from those tech companies, a lot focused on social networking and kind of advertising and selling ads and products to people, to getting back to entrepreneurs figuring out new tech for manufacturing and building and oil, like the bigger companies that we did see previously kind of throughout the 80s and 90s. So I think a lot of tech, a lot of the brain power, and a lot of the financing are going to go back to those kind of bigger projects and less away and more away from those kind of like social engineering kind of projects and hand gadgets. So I think a lot of that money and capital is going to pour into that. I know a lot of the tech money is going into industry for militaries. We build up now like crazy. And we're looking at getting a lot more unmanned systems coming on board. And that's kind of across industry, is looking at more unmanned systems, more technology for manufacturing and production. So as these production plants come back online, they're going to be a lot higher technology level in the regular manufacturing line to whatever they're building, whether it's car parts or whether it's indoor manufactured homes, whether it's the microchips that we need. We're going to see a lot more of that tech evolve into manufacturing instead of personal entertainment.
You gonna say something, Bob?
Oh yeah, I think we're getting, I mean, we can chat a little longer. We don't have to cut it. I know we're going to keep it to 30 minutes, but the one thing I think about, and one of my buddies, he just sold his entire single family portfolio and he's just deploying 100K checks with syndicators. And he's trying to invest in some markets like Phoenix, where he's been seeing a lot of results where in 14 months, you're getting like the 2.3, 2.5 equity multiple. He just wants to like double his money, and that market's obviously super hot. But I see all of these multifamily, syndicators doing well, who are doing the right market and right deal. But what I really find interesting is the cash flow. Like if the cost of things go up, and you guys know me, I love Bitcoin and I believe in it in the future. Do you want like the short-term cash flow and have your money locked up there? Or do you want liquidity? And what is your denominator? Like, what are you judging your returns on? And sure, like Bitcoin's volatile right now. The stock market's actually plunging more than Bitcoin. Bitcoin's holding pretty strong. And when it comes to like larger forces impacting Bitcoin, there was a huge stable coin, Terra. I'm sure y'all heard of that. In UST, it was an algorithmic stable coin. And the CEO, he basically said, I want to be the biggest holder of Bitcoin. And if someone sells off this much Bitcoin, he had about 70,000 of it, it would collapse Bitcoin and just destroy the credibility of crypto. That obviously didn't happen. Their coin went from, if you had like $20 million of it, it's now worth less than $1 from its high to its bottom. So it's like my denominator is Bitcoin. Like I don't really care how much dollars I have. I want enough dollars to get by today. But if I'm forecasting really 10, 15 years out, Bitcoin's the denominator I want to measure for my net worth. And one thing that's really interesting is like 44 countries this last week, or excuse me, like central bankers and like leaders of these non-American countries met in El Salvador to learn about Bitcoin. And a lot of other countries want to embrace it. And we're pretty spoiled in America. Like we don't even have to really think about being under authoritarian regime, which is 80% of the world, nor our currency hyperinflating. We're getting a little taste of it. We can't even fathom what people actually go through. So there's a lot of things happening like that. And like the energy markets adopting Bitcoin and mining. And there's just all this stuff going on. We tend to have a short vision. And I was on the Choice podcast. It's a retirement account that basically lets you get access to any asset. And I was talking to them about why I believe real estate and Bitcoin is the most important. I want cash flow because I need it, because there's going to be volatility in markets. And if something happens with my job, I need something to get me by. But I also have a core savings in Bitcoin because maybe it's call it like deeper education, insider knowledge, whatever. But I see where this thing's going. And if you don't have it in your portfolio, it's just because you don't understand it yet. It's just that simple to me.
Yeah, man, I got a lot to say on that. Brad, you made a good point. I don't know about you, but I haven't really seen any real innovation in tech in years. And, Bobby and I had lived in that world for a long time. And I mean, it's always like, oh, another CRM. Oh, another, app. Oh, another phone. Oh, so, I think that innovation in our monetary system, that's pretty revolutionary. We haven't really seen that before. A whole new version of the internet. We don't really understand that. To Bobby's point, we're finally seeing the disparity between, hey, there's Bitcoin and then there's the rest of the crypto market. And there was a bit of a we'll call it a .com bubble in around all of crypto that just proved itself as predicted. So I think you kind of have that first shakeup, or what they would call like the J hook, on any type of new market, new IPO. And so you're gonna see now on this next run which of those platforms and products really stick around. So that'll be exciting once that gets stabilized. But I also think private equity is going to start looking other places. The big sexy names. There's tons of privately held companies that just print cash. I mean, I have a friend who runs a pretty big, we'll call it contracting business, and he's ran that business for 30 plus years. I mean, he does $14 million a year, but cuts himself $3 million a year, in a check, right? He's just little, Northern Colorado guy, right? Just in that market, right? So obviously, he created something pretty special. How do you take that same concept in business that he built over 38 years and scale it across the country? Real hard to get in businesses. They take really hard work to grow. Not just I can sit in my room and build an app and scale, because as we come back to a more production, manufacturing, American-made type of economy here in the United States, the blue collar worker and the blue collar business, I think, is going to thrive. And so I think that's where you'll see a lot of the money go. And then obviously real estate's just in the middle of that. That's what I love about, I don't care if it's Bitcoin or dollars or pesos or yen or whatever it is. I'll take your rent in whatever form of currency we got going on,
Well, what syndicators are doing? They're getting creative. Like everyone does multifamily. It's like old news now. Now there's people getting into mobile homes, RV parks, parking lots, car washes. And you can look at the numbers. There's 10,000 boomers retiring every day. 20% of them own businesses. And these small businesses make a ton of money, and you can get an SBA loan. You can do no money down, and they cash flow way more than real estate. But are you going to manage that business, or do you know how to hire an operator who can do it? And that's what I'm focused on. Is I want to build something of my own and then leverage that cash to like get into more real estate. How can I creatively get into more real estate? And I think that's going to get tremendously more popular. And we're seeing it become more popular with like a lot of these people on social media preaching on how to acquire businesses instead of just buying a rental and cash flowing a couple $100 a month. Like, why not cash flow 10 grand a month?
Right.
Yeah.
Yeah. Problem there is though, is most of these people don't know how to build people businesses. They're focused on tech and scaling people out of the business. So you're about to see who are the people leaders and who's not. Like a guy like Brad, right? Military, lieutenant commander, high level ranking, thousands of people that you have to oversee and manage. You're going to be able to come out of a role like you're in and go into a people type business like that and crush. You might not be able to go code and build some app and get 15x, but like, I don't care. The business is cutting me a check for $3 million every year. Like, let's go.
And the thing is it's actually, I was speaking to a guy for like an ice making company, and he said, whenever I was talking to him, he was like, dude, all these influencers, like our lead flow is up like 175%. And most of these people are just kicking rocks. Like they're not even serious. They don't know the first thing. They don't understand the challenges. So it's just interesting. People don't get how much work it actually takes. People always think all of this stuff's easy. Like money doesn't come that quick. It takes a lot of work, but there also lies opportunity within that.
Yeah. And out of that work, once they start picking up these small businesses, they see how much work it is. And the successful people that are making $3 million a year, they're working at it, and they need a place to put that money and get it working for themselves. So that's where, our syndication business comes into play, because we'll be able to give them a place to place their money and get better returns in the stock market without any additional time out of what they're already doing in these small businesses that they're picking up. And since they're owning these businesses, they're going to get a huge tax break from the incentives that just roll off of real estate as being one of the most tax advantaged things in the entire US tax code. And I think, second is owning businesses. So the US is going to continue to incentivize that as we grow into this business manufacturing space. It's going to continue to grow commercial real estate and manufacturing and multifamily, and maybe some even retail coming back as we do more production here locally. That retail coming back, and especially the dispersed retail where we're building in the US, or at least in North America, and then distributing in the US, at least in North America. So I think those business owners will continue to need places to place their hard-earned capital after they get it, and it's going to be in real estate, and it hasn't really changed in hundreds of years.
No. Yeah. Do we got time for one more lightning round question, Bob? You got some random headline?
Random headline? Oh, let's see. Let's pull one out. What was a reading before this?
Give it something with numbers so Jeremy can jump on it.
Numbers.
No, I mean, I'm not going to know stats off the cuff. Just been diving back into some podcasts just to get the live like updates from different sources. Otherwise, I don't like pulling my head up from work during the day to read the news. And I don't really like diving too much into the mainstream media anyway. I much prefer podcasts.
What? Mainstream media?
I mean, one thing I think is fascinating this week is Elon Musk. He was saying the media is going to start targeting me. And he was like, I've always voted Democrat because they've been the group of like peace, care, love, whatever words he used. But now they're the ones causing problems and they're acting in hate. And one of the Rothschild boys responded and said, you're spoiled, blah, blah, blah. And it's just kind of like the hubris and just this mouse and cat dance that's going on the Democratic side. It's like we're seeing one of the biggest political shifts in the world. And we've already seen it in real estate. People have left California and New York. They're losing voting power just on a national level. And it's definitely not stopping. And I'm all for it.
I listened to one of the latest episode, I think, of the All In podcast we were talking about this past week. And Elon was on it. I think it was literally 2 days ago it was released. And it's a great episode. Kind of talks about his whole, a bunch of different things and how he's buying Twitter, or he's in the process of potentially buying Twitter. Moving from California to Texas got brought up, and in the whole political thing as well, like just whether he goes out and builds a Twitter from scratch or he acquires it and kind of fixes it into what it needs to be in a democracy type of capitalistic environment. freedom, freedom of speech is always something that's kind of been at the core of that. So if it's not a Twitter, then he'll probably go out and invent something of the nature. And like you said, he's always been he's always kind of contributed to the Democratic Party. So it's not like he's doing this just to bring Trump back onto the platform by any means. It's just kind of like needs to exist. Like this should exist, and I'm going to create it one way or another.
And what's interesting is all I did was leverage his Tesla stock as a way to like get money to buy it without selling it with no tax consequence. So I know that's frustrating to a lot of people, and that'll probably set precedent and lead to some conversations down the line on what and how things be taxed. But that's also why our country was founded on people saying, "Buy, we're not paying the taxes because you're not going to destroy us." And that's where the power of Bitcoin and sovereignty and holding your own, being your own bank, it's the exact principles America was founded on. It's like, yeah, try to tax me, see what happens.
Yeah, and it's another great reason why real estate is amazing, because it's so tax advantaged. So he's going to catch a lot of hate from people who don't read the rule book. So It's pretty simple. You wanna figure out ways to make more money and pay less in taxes, read the rule book. Or for me, read a coloring book about the rule book that then helps you figure out the ins and the outs of how the wealthy continue to get more wealthy. And it's available, and that's a great thing in the US, whether you read it in books or you pick it up in podcasts or you pick it up in Twitter or however you do it. There's information available for people to break out of their current economic situation and move up. It's always been the case, always will be the case in the US. So find the rule book, find out how to win, apply some energy towards it, and get there. And
all right, I got some comedy.
What's
Instead
that?
of MVP or MTV cribs, we're gonna do GVP cribs, and it's like, yo, welcome to my house. This is 150 units. Let's walk through every one.
Yeah, we will.
So
Sure.
2 interesting stats. One, I was completely blown away that Elon Musk has 93.2 million followers. And 2, 9 out of 10 conversations, Bobby will find a way to connect it back to Bitcoin.
That's easy. It's easy.
It's true. Well, this was good, guys. We'll have to definitely do it again. Any final words?
No, this is good. I enjoyed this. This has been my favorite one we've done in a while.
Heck yeah. All right. Well, be good, fellas.
See ya.
Stay tuned for the next one, y'all.
Stay blessed.
Bye.
See ya.
See you guys.